This presentation is for Accounting 221, Accounting Principles 1, Chapter 12, Long-Term Liabilities. The first three learning objectives for Chapter 12 are to journalize transactions for long-term notes payable and mortgages payable, describe bonds payable and journalize transactions for bonds payable and interest expense using the straight-line amortization method. The next three learning objectives are to journalize transactions to retire bonds payable, report liabilities on the balance sheet, and to use the debt-to-equity ratio to evaluate business performance. The last two objectives are to use time value of money to compute present value and future value, and to journalize transactions for bonds payable and interest expense using the effective interest amortization method. In this first section, we will journalize transactions for long-term notes payable and mortgages payable. Long-term liabilities are liabilities that do not need to be paid within 1 year or within the entity's operating cycle, whichever is longer. Both long-term notes payable and mortgages payable are common long-term liabilities. Long-term notes payable are typically reported in the long-term liabilities section of the balance sheet. Recall that most long-term notes payable are paid in installments. The current portion of notes payable is the principal amount that will be paid within 1 year, a current liability. The remaining portion is long-term. For example, Smart Touch Learning signed a $20,000 note payable on December 31st, 2018. The note will be paid over 4 years with payments of $5,000 plus 6% interest each December 31st, beginning December 31st, 2019. Remember that the current portion of the note, the amount due December 31st, 2019, or $5,000, is considered a current liability at December 31st, 2018. The entry requires a debit to cash for $20,000 and a credit to notes payable for $20,000. On December 31st, 2019, Smart Touch Learning will make a $5,000 principal payment plus interest. An amortization schedule is a schedule that details each loan payment's allocation between principal and interest and the beginning and ending loan balances. Smart Touch Learning will calculate interest expense as beginning balance times interest rate times time. The total cash payment is the principal payment plus interest. Exhibit 12.1 shows an amortization schedule for the notes payable. Assume that it is now December 31, 2019, and Smart Touch Learning must make its first installment payment of $5,000 principal plus interest on the note. The entry requires a debit to notes payable for $5,000, a debit to interest expense for $1,200, and a credit to cash for $6,200. After the December 31st, 2019 entry, Smart Touch Learning owes $15,000, $20,000 original note amount minus the $5,000 principal paid on December 31st, 2019. The company will record similar entries for the three remaining payments using the amounts calculated in the amortization schedule. Mortgages payable include the borrower's promise to transfer legal title to specific assets if the mortgage isn't paid on schedule. Mortgages payable are very similar to long-term notes payable. The main difference is that mortgages payable are secured with specific assets, whereas long-term notes are not secured with specific assets. As with long-term notes payable, the total mortgages payable amount has a portion due within 1 year, current, and a portion that is due more than 1 year from a specific date. Mortgages commonly specify a monthly payment of principal and interest to the lender, usually a bank. The most common type of mortgage is on property, for example, a mortgage on your home. Assume that on December 31, 2018, Smart Touch Learning purchases a building for $150,000, paying $49,925 in cash and signing a 30-year mortgage for $100,075, taken out at 6% interest that is payable in $600 monthly payments, which includes principal and interest beginning January 31st, 2019. A partial amortization schedule for 2018 and 19 is shown in Exhibit 12.2. We can confirm the interest calculations provided in the amortization table. The first payment on the interest is calculated as $100,075 times 6% times 1 divided by 12, or $500.38. The principal of $99.62 is the difference between the monthly payment of $600 and the interest expense of $500.38. The $99.62 reduces mortgages payable from $100,075 to $99,975.38. Each mortgage payment will be recorded in a similar journal entry using the amortization schedule amounts. In the second section, we will describe bonds payable. Large companies need large amounts of money to finance their operations. They may take out long-term loans from banks and/or issue bonds payable to the public to raise the money. Bonds payable are long-term debts issued to multiple lenders called bondholders, usually in increments of $1,000 per bond. By issuing bonds payable, companies can borrow millions of dollars from thousands of investors rather than depend on a loan from one single bank or lender. Each investor can buy a specified amount of the company's bonds. The face amount is the amount a borrower must pay back to the bondholders on the maturity date. Face value is also called maturity value, principal amount, or par value. The maturity date is the date on which the borrower must pay the principal amount to the bondholders. The stated interest rate is the interest rate that determines the amount of cash interest the borrower pays and the investor receives each year. The stated rate is also called face rate, coupon rate, or nominal rate. People buy or invest in bonds to earn interest. The bond certificate states the interest rate that the company will pay and the dates the interest is due, generally semi-annually or twice per year. Exhibit 12.3 shows a bond certificate issued by Smart Touch Learning. There are various types of bonds, including the following. Term bonds are bonds that mature all at the same time. For example, $100,000 of term bonds may all mature 5 years from today. Serial bonds mature in installments at regular intervals. For example, a $500,000 5-year serial bond may mature in $100,000 annual installments over a 5-year period. Secured bonds give the bondholder the right to take specified assets of the issuer if the issuer fails to pay principal or interest. Debentures are unsecured bonds that are not backed by assets. They are backed only by the creditworthiness of the bond issuer. A bond can be issued at any price agreed upon by the issuer and the bondholders. A bond can be issued at any of the following: face value, which occurs when a bond is issued for its face value, example, a $1,000 bond issued for $1,000. Discount, a discount on bonds payable occurs when the issue price is less than face value. For example, a $1,000 bond issued for $980, the discount is $20. A premium, which is when a bond payable when the issue price is above face value. For example, a $1,000 bond issued for $1,015, the premium is $15. The issue price of a bond does not affect the required payment at maturity. In all of the preceding cases, at the maturity date stated on the face of the bond, the company must pay the face value of the bond. The issue price of a bond determines the amount of cash the company receives when it issues the bond. In all cases, the company must pay the bond's face value to retire it at the maturity date. Exhibit 12.4 shows sample price information for the bonds of Smart Touch Learning. On this particular day, 12 of Smart Touch Learning's 9% bonds maturing in 2021 were traded. The bond's highest price on this day was $795, which is 1,000 times 0.795. The lowest price of the day was $784.50, which is $1,000 times 0.7845. The closing price, or the last sale of the day, was $795. Money earns interest over time, a fact called the time value of money. The time value of money is the recognition that money earns interest over time. The present value is the amount a person invests now to receive a greater amount in the future. The future value is the value of the investment at a specific date in the future. Assume that a $1,000 bond reaches maturity 3 years from now and carries no interest. Would you pay $1,000 to purchase this bond? No, because paying $1,000 today to receive $1,000 later yields no interest on your investment. How much would you pay today in order to receive $1,000 in 3 years? The answer is some amount less than $1,000. Suppose $750 is a fair price. By investing $750 now to receive $1,000 later, you will earn $250 over the 3 years. The diagram shown here illustrates the relationship between a bond's price, its present value, and its maturity amount or future value. In this example, $750 is the present value or market price of the bond, and the $1,000 face value to be received in 3 years is the future value, the value of the investment at a specific date in the future. Bonds are sold at their market price, issue price on the date the bonds are first sold, which is the present value of the interest payments the bondholder will receive while holding the bond plus the present value of the bond principal paid at the end of the bond's life. Two interest rates work together to set the price of a bond. The stated interest rate determines the amount of cash interest the borrower pays each year. The stated interest rate is printed on the bond and does not change from year to year. The dollar amount of interest paid is not affected by the issue price of the bond. The market interest rate, also known as the effective interest rate, is the rate that investors demand to earn for loaning their money. The market interest rate varies constantly. A company may issue bonds with a stated rate that differs from the market interest rate due to the time gap between the time the bonds were printed or engraved, showing the stated rate, and the actual issuance of the bonds. Exhibit 12.5 shows how the stated interest rate and the market interest rate work together to determine the price of a bond. Borrowing by issuing bonds payable carries a risk. The company may be unable to pay off the bonds and the related interest. Why do companies borrow instead of issuing stock? Debt is a less expensive source of capital than stock, and bonds do not affect the percentage of ownership of the corporation. Companies face the following decision. How shall we finance a new project, with bonds or with stock? Financial leverage occurs when a company earns more income on borrowed money than the related interest expense. Smart Touch Learning's management believes the new cash can be used to increase income before interest and taxes by $200,000 each year. The company estimates income tax expense to be 40%. Exhibit 12.6 shows the advantage of borrowing as it relates to earnings per share. In the third section, we will learn how to journalize transactions for bonds payable and interest expense using the straight line amortization method. The basic journal entry to record the issuance of bonds payable debits cash and credits bonds payable. As noted previously, a company may issue bonds, a long-term liability, at face value, at a discount, or at a premium. Smart Touch Learning has $100,000 of 9% bonds payable that mature in 5 years. The company issues the bonds at face value on January 1st, 2018. Smart Touch Learning, the borrower, makes this one-time journal entry to record the receipt of cash and issuance of bonds payable. The entry includes a debit to cash and a credit to bonds payable for the face value of the bonds, $100,000. Smart Touch Learning, the borrower, makes this one-time journal entry to record the receipt of cash and issuance of bonds payable. Interest payments occur each June 30th and December 31st. Smart Touch Learning's interest journal entry includes a debit to interest expense for $4,500, $100,000 times 9% times 6 divided by 12, and a credit to cash for $4,500. Each semi-annual interest payment follows this same pattern. We know that market conditions may force a company such as Smart Touch Learning to accept a discounted price for its bonds. Suppose Smart Touch Learning issues $100,000 of its 9% 5-year bonds that pay interest semi-annually when the market interest rate is 10%. The market price of the bonds drops to 96.149, which means 96.149% of face value. Smart Touch Learning receives $96,149 at issuance and records a debit to cash for $96,149, a debit to discount on bonds payable of $3,851, and a credit to bonds payable of $100,000. After the entry post, the T accounts have a credit balance for bonds payable of $100,000 and a credit balance for discount on bonds payable of $3,851. The net carrying value of $96,149 will be reported on the balance sheet. Discount on bonds payable is a contra account to bonds payable. Bonds payable minus the discount gives the carrying amount of bonds, also known as the carrying value. The carrying amount of bonds is the bonds payable minus the discount account current balance or plus the premium account current balance. Smart Touch Learning would report these bonds payable on the balance sheet under the long-term liabilities section, with $100,000 showing as bonds payable and $3,851 as discount on bonds payable, for a carrying value of $96,149. We can amortize a bond discount by dividing it into equal amounts for each interest period. This is called the straight line amortization method. The straight line amortization method is a method that allocates an equal amount of bond discount or premium to each interest period over the life of the bond. It works very much like the straight line depreciation method we discussed for plant assets in Chapter 9. In our example, the initial discount is $3,851, and there are 10 semi-annual interest periods during the bond's 5-year life. 5-year life times 2 interest payments per year. Therefore, 1/10 of the $3,851 bond discount, or $385 rounded, is amortized each interest period. The entry requires a debit to interest expense for $4,885 and a credit to cash for $4,500 and a credit to discount on bonds payable of $385. The entry shown on the previous slide would be made again on December 31st, 2018. So the bond discount balance would be $3,081 on December 31st, 2018. Discount on bonds payable has a debit balance. Therefore, we credit the discount on bonds payable account to amortize or reduce its balance. 10 amortization entries will decrease the discount to 0 with rounding. Then the carrying amount of the bonds payable will be $100,000 at maturity. $100,000 in bonds payable minus 0 in discount on bonds payable. Exhibit 12.7 shows the amortization schedule of the bond. The bonds payable account and the premium on bonds payable account each carry a credit balance. Premium on bonds payable is an adjunct account to bonds payable. An adjunct account is an account that is directly related to another account. Adjunct accounts have the same normal balance as the related account and are added to the related account on the balance sheet. Adjunct accounts work similarly to contra accounts. The only difference is that an adjunct account has the same type of balance as the main account, whereas a contra account has the opposite type of balance from its main account. Therefore, we add premium on bonds payable to bonds payable to determine the bond's carrying value. To illustrate a bond premium, let's change the Smart Touch Learning example. Assume that the market interest rate is 8% when Smart Touch Learning issues its 9% 5-year bonds. These 9% bonds are attractive in an 8% market, and investors will pay a premium to acquire them. Assume that the bonds are priced at 104.1, 104.1% of the face value. In this case, Smart Touch Learning receives $104,100 cash upon issuance. Smart Touch Learning records a debit to cash of $104,100, a credit to premium on bonds payable of $4,100, and a credit to bonds payable of $100,000. After the entry post, the T accounts have a credit balance for bonds payable of $100,000 and a credit balance for premium on bonds payable of $4,100. The net carrying value of $104,100 will be reported on the balance sheet. Interest expense of $4,090 is the stated interest of $4,500, which is paid in cash, minus the amortization of the premium of $410. This same entry would be made again on December 31st, 2018, so the bond premium balance would be $3,280. Exhibit 12H shows the amortization schedule of a bond issued at a premium. In the fourth section, we will journalize transactions to retire bonds payable. Retirement of bonds payable involves paying the face value of the bonds. Bonds can be retired at the maturity date or before. When a bond is matured, the carrying value always equals the face value. In the case of Smart Touch Learning, with both the discount and premium examples, on December 31st, 2022, the carrying amount and the face value are $100,000. The entry to retire the bonds includes a debit to bonds payable of $100,000 and a credit to cash of $100,000. Normally, companies wait until maturity to pay off or retire their bonds payable, but sometimes companies retire their bonds prior to maturity. The main reason for retiring bonds early is to relieve the pressure of paying the interest payments. Some bonds are callable. Callable bonds are bonds that the issuer may call and pay off at a specific price whenever the issuer wants. The call price is usually 100 or a few percentage points above face value, perhaps 101 or 102, to provide an incentive for the bondholder. Callable bonds give the issuer the flexibility to pay off the bonds when doing so benefits the company. An alternative to calling the bonds is to purchase any available bonds in the open market at their current market price. Whether the bonds are called or purchased in the open market, the same accounts are used in the journal entry. Suppose on December 31, 2018, Smart Touch Learning has $100,000 of bonds payable outstanding with a remaining discount balance of $3,081. The original discount of $3,851 less the straight line amortization of $385 in June and December. Lower interest rates have convinced management to pay off these bonds now. These bonds are callable at $100. If the market price of the bonds is $95, should Smart Touch Learning call the bonds at $100 or purchase them in the open market at $95? The market price is lower than the call price, so Smart Touch Learning should buy the bonds on the open market at their market price. Retiring the bonds on December 31st, 2018 at $95 results in a gain of $1,919, which is the difference between the carrying value of $96,919 and the market price of $95,000. The entry requires that the bonds be removed from the books by recording a debit to bonds payable of $100,000, a credit to the remaining discount on bonds payable of $3,081, and a credit to cash of $95,000. In order to balance the journal entry, a gain on retirement of bonds needs to be recorded with a credit of $1,919. After posting, the bond accounts have zero balances. The journal entry removes the bonds from the books and records a gain on retirement. If the bonds being retired have a premium rather than a discount, any existing premium is removed with a debit. If Smart Touch Learning retires only half of these bonds, it removes only half the discount or premium. To retire bonds before maturity, first you record partial period amortization of discount or premium and partial period interest payment if the retirement date does not fall on an interest payment date. Remove the portion of any unamortized discount or premium that relates to the bonds being retired, debit bonds payable at face value, credit a gain or debit a loss on retirement, and credit cash for the amount paid to actually retire the bonds. In the fifth section, we will learn how to report liabilities on the balance sheet. At the end of each period, a company reports all of its current and long-term liabilities on the balance sheet. As we have seen throughout the textbook, there are two categories of liabilities, current and long-term. Exhibit 12.9 shows the liabilities portion of Smart Touch Learning's balance sheet, amounts assumed, that we have discussed up to this point. In the sixth section, we will use the debt-to-equity ratio to evaluate business performance. The relationship between total liabilities and total equity, called the debt-to-equity ratio, shows the proportion of total liabilities relative to the total equity. Thus, this ratio measures financial leverage. If the debt-to-equity ratio is greater than 1, the company is financing more assets with debt than with equity. If the ratio is less than 1, the company is financing more assets with equity than with debt. The higher the debt-to-equity ratio, the greater the company's financial risk. This slide shows Kohl's Corporation's total liabilities and total equity in millions that were reported on its fiscal 2015 annual report. Kohl's debt-to-equity ratio as of January 30, 2016 is above 1, indicating that the company is financing more assets with debt than with equity. Notice that its debt-to-equity ratio is not improved from January 31, 2015, when Kohl's had a debt-to-equity ratio of 1.39. This has to do with the fact that Kohl's experienced a decrease in liabilities that was smaller than the decrease in equity during 2015. Kohl's debt-to-equity ratios for both years indicate that the company is taking advantage of financial leverage, but is at a higher risk than a company that finances assets with less debt and more equity. In the seventh section, we will use the time value of money to compute present value and future value. A dollar received today is worth more than a dollar to be received in the future, because you can invest today's dollar and earn additional interest, so you'll have more cash next year. The time value of money concept explains why we would prefer to receive cash sooner rather than later. The time value of money depends on these key factors: the principal amount, P, the number of periods, N, and the interest rate, I. The principal, P, refers to the amount of the investment or borrowing. We state the principal is either a lump sum or an annuity. An annuity is a stream of equal cash payments made at equal time intervals. For example, $100 cash received per month for 12 months is an annuity. The number of periods, N, is the length of time from the beginning of the investment or borrowing until termination. All else being equal, the shorter the investment or borrowing period, the lower the total amount of interest earned or paid. The interest rate, I, is the percentage earned on the investment or paid on the borrowing, and can be stated annually or in days, months, or quarters. The interest rate must reflect the number of time periods in the year. Simple interest is interest calculated only on the principal amount. Compound interest is interest calculated on the principal and on all previously earned interest. Compound interest assumes that all interest earned will remain invested and earn additional interest at the same interest rate. Exhibit 12A1 compares simple interest at 6% on a 5-year $10,000 investment with interest compounded yearly, rounded to the nearest dollar. As you can see, the amount of compound interest earned yearly grows as the base on which it is calculated. Principal plus cumulative interest to date grows. Over the life of the investment, the total amount of compound interest is more than the total amount of simple interest. Most investments yield compound interest, so we assume compound interest rather than simple interest for this chapter. The future value of the investment is calculated by adding the principal plus the interest earned. Present value is equal to future value minus interest earned. So the only difference between present value and future value is the amount of interest that is earned in the intervening time span. Mathematical formulas specify future values and present values for unlimited combinations of interest rates and time periods. Separate formulas exist for single lump sum investments and annuities. Present value tables contain the results of the formulas for various interest rate and time period combinations. This table provides a description of each of the present and future value tables in Appendix A. The present value of $1 is found in Appendix A, Table A1, and is used to calculate the value today of one future amount, a lump sum. The data in each table, known as present value factors, are for an investment or loan of $1. To find the present value of an amount other than $1, multiply the present value factor by the future amount. We determine the present value factor from the table labeled Present Value $1, Appendix A, Table A1. We use this table for lump sum amounts. We look down the 6% column and across the 5 periods row and find that the present value factor is 0.747. If approximately $9,997 is invested today at 6% for 5 years, at the end of 5 years the investment will grow to $13,383. Let's now assume that instead of receiving a lump sum at the end of the 5 years, you will receive $2,000 at the end of each year. This is a series of payments, $2,000 over equal intervals or years, so it is an annuity. How much would you have to invest today to receive these payments, assuming an interest rate of 6%? We determine the annuity or present value factor from the table labeled Present Value of Ordinary Annuity of $1, or in Appendix A, Table A2. We use this table for annuities. We look down the 6% column and across the 5 periods row and find the annuity present value factor is 4.212. Let's verify the calculation. The chart shows that the initial investment of $8,424 is invested for 1 year, earning $505 in interest. At the end of that period, the first withdrawal of $2,000 takes place, leaving a balance of $6,929, calculated as $8,424 plus $505 less $2,000. At the end of the 5 years, the ending balance is zero, proving that the present value of the $2,000 annuity is $8,424. We can use what we have just learned about the present value of a lump sum and present value of an annuity to calculate the present value of bonds payable. The present value of a bond, its market price, is the sum of the present value of the principal amount to be paid at maturity, a single amount, present value of a lump sum, and the present value of the future stated interest payments, an annuity, because it occurs in equal amounts over equal time periods, or the present value of an annuity. Let's compute the present value of Smart Touch Learning's 9% 5-year bonds. The face value of the bonds is $100,000, and they pay 9% times 6 divided by 12, or 4.5% stated interest semi-annually. At issuance, the annual market interest rate is 10%, or 5% semi-annually. Therefore, the market interest rate for each of the 10 semi-annual periods is 5%. We use 5% to compute the present value of the maturity value and the present value of the stated interest. The present value of these bonds is $96,149. The present value of the principal is $61,400, the face value of $100,000 times the present value factor of 0.614. The present value of the interest payments and annuity is $34,749, calculated at $100,000 times 9% times 6 divided by 12, and then times 7.722. The present value of the bonds is the sum of the present value of the principal plus the present value of the interest payments. $96,149 equal to $61,400 plus $34,749. Let's compute the present value of Smart Touch Learning's 9% 5-year bonds. The face value of the bonds is $100,000, and they pay 9% times 6 divided by 12, or 4.5% stated interest semi-annually. At issuance, the annual market interest rate is 8%, or 4% semi-annually. Therefore, the market interest rate for each of the 10 semi-annual periods is 4%. We use 4% to compute the present value of the maturity value and the present value of the stated interest. Let's consider a premium price for the Smart Touch Learning bonds. The present value of the principal is $67,600. The face value of $100,000 times the present value factor of 0.676. The present value of the interest payments and annuity is $36,500. 100,000 times 9% times 6 divided by 12 times 8.111. The present value of the bonds is the sum of the present value of the principal plus the present value of the interest payments, $104,100, which is equal to $67,600 plus $36,500. If I invested $100,000 today in the present time, how much would I have in 5 years at an interest rate of 6%? We will calculate the future value using future value factors. We determine the future value factor from the table labeled future value of $1 in Appendix A, Table A3. We use this table for lump sum amounts. We look down the 6% column and across the 5 periods row and find the future value factor is 1.338. Notice that the calculation is off by $3 due to rounding. The future value factors are rounded to 3 decimal places, so the calculations may not be exact. Also, the interest calculations in Exhibit 12A1 were rounded to the nearest dollar. Therefore, there are 2 rounding issues in this exhibit. However, we do have the answer to our question. If $10,000 is invested today at 6% for 5 years, at the end of 5 years the investment will grow to $13,380. Calculate the future value of an annuity, assuming that you will receive $2,000 at the end of each year. This is a series of equal payments, $2,000 over equal intervals or years, so it is an annuity. How much would these payments be worth 5 years from now, assuming an interest rate of 6%? We determine the annuity future value factor from the table labeled Future Value of Ordinary Annuity of $1, or in Appendix A, Table A4. We use this table for annuities. We look down the 6% column and across the 5 periods row and find the annuity future value factor is 5.637. Investing $2,000 per year for 5 years at 6% will yield $11,274. The reason is that interest is being earned on principal that is left invested each year. In the last section, we will learn how to journalize transactions for bonds payable and interest expense using the effective interest amortization method. A more precise way to amortize bonds is called the effective interest amortization method. The effective interest amortization method is a model that calculates interest expense based on the current carrying amount of the bond and the market interest rate at issuance, then amortizes the difference between the cash interest payment and calculated interest expense as a decrease to the discount or premium. Generally accepted accounting principles require that interest expense be measured using the effective interest amortization method unless the straight line amounts are similar. Total interest expense over the life of the bonds is the same under both methods. However, interest expense each year is different between the 2 methods. Assume that Smart Touch Learning issues $100,000 of 9% bonds at a time when the market interest rate is 10%. These bonds mature in 5 years and pay interest semi-annually, so there are 10 semi-annual interest payments. As you just saw in Appendix 12A, the issue price of the bonds is $96,149, and the discount on these bonds is $3,851. When using the effective interest amortization method, the amount of the interest expense is calculated using the carrying amount of the bonds and the market interest rate. The interest payment is calculated using the face value of the bonds and the stated interest rate. The amount of discount amortization is the excess of the calculated interest expense over the interest payment. Exhibit 12B1 shows how to calculate interest expense by using the effective interest amortization method. When recording the interest payment for the bonds payable, the accounts debited and credited under the effective interest amortization method and the straight line amortization method are the same, only the amounts differ. The journal entry requires a debit to interest expense of $4,807, a credit to cash of $4,500, and a credit to discount on bonds payable of $307. Smart Touch Learning may issue its bonds at a premium. Assume that Smart Touch Learning issues $100,000 of 5-year 9% bonds when the market rate of interest is 8%. The bond's issue price is $104,100 and the premium is $4,100. When a bond is issued at a premium, the interest expense calculation using the effective interest amortization method uses the carrying amount of the bonds and the market interest rate as shown with the discounted bond. The calculation of premium amortization is calculated as the difference between the cash paid and the calculated interest expense. Exhibit 12B2 provides the amortization schedule using the effective interest amortization method for Smart Touch learning. The journal entry requires a debit to interest expense of $4,164, a debit to premium on bonds payable of $366 or $336, and a credit to cash of $4,500. Regardless of which method is used, the total amount of cash paid and total interest expense are the same. This is the conclusion of the presentation for Chapter 12.